Okay, here we're continuing our discussion of ARC section 90A, and that's for the review of financial statements. And here we'll be talking about in this video the reference, when we need to reference to the work of other accountants in our accounts review report. So if we're reviewing the financial statements of maybe like a really big entity that consolidates a whole lot of different subsidiaries, and we employ another accounting firm to audit or review certain of the subsidiaries, but we're the lead reviewer on the engagement, then we need to make reference, or if we decide that we don't want to assume responsibility for that other review or audit that was performed by the other accountants, then we should make reference to that review in our accounts review report if we're the lead on the engagement. So in that instance, we would clearly indicate in our accounts review report that we use the work of other accountants, and we should include the magnitude of the portion of the financial statements that the other accountants did. And so whether or not we decide to assume the responsibility of that other accountant that did that other work, or to put it on them by referencing them in our accounts review report, we should still communicate with the other accountants to make sure that they're aware that the financial statements of the component that they're auditing or reviewing will be included in the financial statements under our review, and that we will rely on their report as a basis in our coming to our conclusions. We should also ascertain that the other accountants are familiar with the applicable financial reporting framework and with Sawyer's or auditing standards generally accepted in the United States of America as applicable, and will conduct the review or audit in accordance therewith. So we need to make sure that they're actually capable of performing the job and that we can rely on the report that they're providing. And also we should ascertain that a review will be made of matters affecting elimination of intercompany transactions and accounts, and if appropriate in the circumstances, the uniformity of accounting practices among the components included in the financial statements. So this is here to make sure that we ensure the eliminations are made properly, because if we rely on the report of the other accountant in that particular component, they won't be considering eliminations with the parent company or other subsidiaries other than just intercompany accounts. So we, as the lead, need to make sure that those intercompany accounts reconcile between the subsidiaries or components. So in general, it's up to us, if we are the lead accountant, to decide if we want to rely on the other accountants that did a component of the overall entity that's under our review. And if we do rely on their work, we maybe don't need to mention them. Or if we assume the results of their work, then we don't need to mention them in our accounts review report. But if we don't want to assume their work, and we want to rely on their work as evidence in our audit or in our review, then we would need to notify the users of the financial statements in our accounts review report that they performed certain components of our work and they performed X, X, and X. And regardless of how we want that to work, we also need to let the other accountant know that we are relying on their work. We need to make sure that they're competent and able to do the work that we need them to do. And we also need to make sure that the intercompany transactions are eliminated. So we've got some explanatory material here, so let's go down and take a look at that and make sure if there's any other details that we need to know about this. Okay, now we're down in the explanatory material at A128 through A130, discussing our reference to the work of other accountants in our accounts review report. So it says here the lead accountant, that's the one that's the accountant of the reporting entity, may make reference to any other accountants who audited or reviewed significant components of this entity. And so, for example, if the consolidated entity is made up of 3 components, one of those components is audited or reviewed by another accountant. The second component is audited or reviewed by another accountant, and we audit or review the third component, then we can decide whether we make reference to one of the other accountants, to both of the other accountants, or neither. And that decision is solely at our discretion and judgment. And so if we do decide to reference those other accountants in our report, remember we have to discuss the magnitude of the portion of the financial statements that the other accountants took care of. And so we can do that by either stating dollar amounts or percentage amounts of assets or revenues or any other criteria or combination of these that clearly describes the portion of the financial statements that were audited or reviewed by other accountants. So when 2 or more other accountants participate in audit or review, the dollar amounts or percentages covered by those other accountants may be stated in the aggregate. So you don't necessarily have to say that accountant 1 covered X percent of the assets, accountant 2 covered X percent of the assets. We can say that other accountants audited or reviewed the total that those 2 other accountants audited or reviewed. So Exhibit C has an example of appropriate reporting in our accounts review report when we reference another audit or review of one of the components in a review that we are performing as the accountants of the reporting entity. So let's go down to Exhibit C and take a look at that. Okay, now we're down at Exhibit C for illustrations of accountants review reports. And we have 6 illustrations here, as we've seen in our prior videos. And we see here illustration 6 is appropriate for our purposes in this video. For the report is called Accounts Review Report on Comparative Consolidated Financial Statements, in which the accountant makes reference to the work of other accountants who are engaged to review the financial statements of a significant component. So let's go down to illustration 6 and see how they disclose the reference to another accountant. So we have all the normal components of the report, the period under review, the entity, what the review includes, and its limitations, management's responsibility for the financial statements, our responsibility for the financial statements, and this is where we reference the other accountant. We say that we have not reviewed the financial statements of B company, a wholly owned subsidiary whose financial statements reflect X percentage of assets and X percentage of revenues, and we say that our report, based on that other entity or component of the assets and revenues, was based solely on the report of this other accountant. And so that's it. It's pushing some of our responsibility onto that other accountant, although we are still responsible for the entire reporting entity, which includes this. We're just notifying the users of the financial statements that we rely solely on their work as a basis for our evidence for this entity. And the rest of the components of the report are the same as in other sections within ARC Section 90A.